right. So thank you everybody for attending Jesse Dolney's DBA doctoral defense. I've had an opportunity to know and work with Jesse now for about 4 years. I tried to show him the finer points in whitewater, but he's I know he's worked hard, and we had a few bumps along the way, like most dissertations have, but we got where we wanted to be in the end. So it's my pleasure to introduce Jesse.
Thank you, Garrett. I really appreciate that, and I appreciate everything that you and my committee have done for me through this process, to include you, DK, and Daniel as well, and Praveen. Thank you for everything along the way to finally get here. So, going right into it, my dissertation is focused on strategic management and technological integration in real estate investment trusts. And with that, this is our agenda. So we have 12 different points that we're going to be covering through the introduction, down through the process that we went through, this a tri-essay model, and then we'll get into the data, the results, and then final takeaways. So, like I had said, thank you again for my committee and everybody that got me to this point, to include Whitewater staff, my cohorts, and then my family and friends. Without everybody in this environment, this wouldn't have happened. A little bit about me. I am a managing director, CEO of my own company, where I have real estate in multiple states. And I also work as a flight paramedic. So with that, I can handle high stakes situations and, operational discord. My education includes being a DBA candidate here at UW Whitewater. I have a master's in business administration, bachelor's of science in international business, an associate's in applied art and paramedic science, and an associate's in general studies, in addition to a certificate in project management from Google. My motivation for this project. So one of the biggest things that I've learned through all of my research through this is just how big REITs are. They're massive. They are in almost every retirement account. They are in institutional investing and so on. And so many people don't know anything about them. To the point that they are, at this point, $4.5 trillion in assets that are influencing 168 million Americans. That's a lot of people that may know about REITs or may not know about REITs. And with that, any small change in efficiency has a massive impact on REITs and the value of the money that you have. So the problem statement for my dissertation comes down to a couple different points. One of which is, when and why do REITs internalize property management? And there's so many different aspects to that. Whether it's growth or locality or just timing. And another interesting aspect that I wanted to delve into more is the aspects of technology related disclosures and how that affects operating efficiency and performance within REITs. And also how different theories affect the structure and the outcome of REITs. So my research questions for essay 1 are the tensions and gaps that exist in real estate investment trusts and how they affect the structure and performance through evidence. And how does transaction cost economics and agency theory and resource-based view overlap or differ within that? For essays 2 and 3, it's which firm characteristics predict internal property management, and how does technology-related disclosures relate to the G&A intensity, ROA, and FFO for these REITs. So with the tri-essay structure, the intent was the first essay is going into what literature exists and how that could impact further research. And then the second and third essays were the essays where we took data and looked for our variables. We looked for information to further identify how REITs are using property management and technology. And the theory behind that we looked at includes transaction cost economics, agency theory, resource-based view, CAM, and DOI. So with the essay 1, as I talked a little bit about, so this is going to be the synthesis of the REIT literature. So for this, we utilized 38 different studies. And we looked at everything from self-advised REITs to externally advised REITs, and trying to find data on internal and external property management. And what could be found from this is that internal control matters, but it's not a universal rule. With essay 2, it's the internal property management essay, where we're looking at what is influencing internal versus external property management and trying to predict when those REITs are bringing that property management in-house. So we use Logit and Probit regression models for this, and focused on firm size, sector, leverage, their fees and costs. And we did the best that we could to predict internal property management and what characteristics that were observable led to that. Essay 3 focuses on technology-related disclosures and performance. So previously, I was looking at technology adoption with this, and over the course of the process, it became more relevant to look at it as technology-related disclosures, because we don't know exactly what's leading to the adoption, but we're looking at who's using it and who's saying that they're using it. And this is examining prop tech, AI, IoT, smart building technology, all the different facets of technology that can increase that efficiency for REITs. We used NLP, so we scraped data from the SEC filings, the 10Ks, to be able to see in there where they were referencing this and how we could utilize that data. Some prior works that influenced this dissertation. So Capoza and Seguin, they looked at externally advised REITs and that they underperform internally. And there's agency conflicts and fee incentives. Ghosh and Sermons, they looked at board independence, ownership structure, and performance. And board independence and ownership shape is important on the REIT performance. With that, it's important to include institutional ownership and governance controls. Some additional prior works on measuring of operational efficiency would be Anderson, Fox, Springer, and Webb. And they focused on technical efficiency and economies of scale. And they were showing that scale does in fact matter with REITs. So as a larger REIT makes smaller decisions, those smaller decisions impact. Nicholson and Stevens also looked at REIT operational efficiency, and they looked at efficiency differences and how they were linked to structure and market context. And then Baracha, Feng, and Hardin looked at efficiency and how it affects performance, risk, and returns. And they were able to show that efficiency is associated with operating performance, risk, and stock returns. So the hypotheses for essay 2, and this is the essay that focuses on internal property management. As you can see, larger scale is associated with higher probability of internal property management. Higher advisory fee burden is associated with higher probability. Greater geographic dispersion is associated with higher probability. Stronger G&A efficiency is associated with lower probability, and asset complexity and property type moderate these associations. And then moving into the hypotheses for essay 3, and again, this is the one that's focused on technology-related disclosure and performance. So this is going to be technology disclosures associated with lower G&A intensity, and technology disclosure associated with higher FFO share or ROA. Associations are stronger for REITs with internal property management, and associations vary by property type and remain sensitive to controls. So the most important thing to note here is these hypotheses test whether disclosure visible technology activity relates to outcomes, not whether technology implementation caused those outcomes. So going into the data sources, so a lot of the data came from the SEC, from the Edgar database in the 10Ks. And that's where we did a lot of scraping of that data. We also pulled data from CompuStat and CRISP. And we were able to merge those data sets together and look for overlap between the two to make one whole set of data. So it includes US equity REITs with sufficient filings and financial data. And we excluded mortgage REITs because it didn't feel appropriate for the type of studies that these were to include those. And we control for IPO, age, and we winterized the extreme data. It includes property type and controls as such, and years for fixed effects. So the final sample is built around matched observations with observation labels, disclosure measures, and financial outcomes. So major variables for SA2, it includes internal property management, log, advisory fee burden, geographic dispersion, G&A efficiency, and leverage. So the advisory fees are a control, and property management structure is the core construct in this essay. And then moving into essay 3 variables. So this would be the technology related essay. And we focus on technology related disclosures, FFO per share or ROA, G&A intensity, internal property management, and our controls for this as well. So for this one, disclosure is strategic signaling, and it's not proof of implementation depth or technology spending. The methods for essay 2. So this is where we would take our Edgar data, and we were looking at internal versus external property management. And we would also look at the S&L data and see what we had in total there. Use logit and probit models. And again, we were looking at internal property management. So with this one, at the end of the day, marginal effects interpreted the probability point differences in internal property management and our empirical model for essay 2, we are looking at performance. So our dependent variables are ROA and looking at the operating profitability and the G&A and the assets as the overhead. And our key coefficient for this was our beta 1, and that estimated the adjusted association between internal property management and performance. And our controls for essay 2 included size, geographic diversification, institutional ownership, property type, and year effects. And the interpretation was expected for the beta 1, positive for ROA and negative for G&A assets. And the results are adjusted associations and not causal estimates. So moving into essay 3. So again, this is our technology essay. So again, we took the Edgar 10K data and we were looking at AI and Internet of Things and smart building disclosures. And we used OLS modeling to relate technology related disclosures with G&A and assets and FFO over share with firm controls. So with this essay, it's a disclosure performance association model and not a technology causality model. And for the operational efficiency model for essay 3, we looked at G&A over assets as our dependent variable. And key variables included the disclosure of AI, Internet of Things, smart building disclosures, indicator index, and looking at internal property management if it could be found. And sector controls included property type, size, leverage, age, market cap, capex, and ownership. And with this part of essay 3, the beta 1 estimates the association between technology related disclosure and G&A intensity. And negative beta 1 would be consistent with lower overhead intensity. And the second half of essay 3 is the financial performance model. And with this one, we're looking at the FFO share as the dependent variable which is the REIT-specific cash performance measure, and key variables to include the disclosure of AI, IoT, smart building disclosures, internal property management, and looking at the compatibility complementarity test for disclosure by internal property management, and the property type heterogeneity test for disclosure over sector. The interpretation, Beta 1 estimates the association between technology-related disclosure and FFO over share. Beta 4 tests whether the association differs between property management is in fact internal. And for this model, it being positive would suggest higher FFO over share among disclosing firms. And if it were negative, it may reflect cost friction or transition. Identification, validity, and robustness. So for this, the purpose is ultimately looking at the limits of this study and the work that we did. So the results are adjusted associations, not causal estimates, and it considers timing and pre-trends where observable. Did the best to have fair comparisons throughout the data within years and property type, to control for size, leverage, geography, capex, age, and ownership. And the labels throughout the data came from the 10K text specifically, so we relied on that. And we cross-checked those labels throughout the data. We Windsorized outliers, and the most important aspect of this is that the report of marginal effects and coefficient estimates is with uncertainty. Yeah. So for robustness and sensitivity checks, the alternative outcomes were looked at for all of the different variables, and we did comparability checks, comparing and disclosing and non-disclosing similar size, leverage, sector, and age, and tried to test whether results reflected technology specific language rather than generic forward-looking language. So these checks were done ultimately to test whether the associations are stable and that they do not establish causality. So the workflow for both essays. For essay 2, the internal property management essay was to build the Fernier data set through all of the data that we had acquired, to label it, clean it, and find each specific item that we wanted to isolate in that data set, and then to estimate models for internal property management through that data set. And look at that data multiple different ways to see and ensure that we're satisfied with the results that we received. And we did that through property type, size groups, and looking at advisory fee burden as well. With essay 3, that essay did build upon the data set. So once the data set was established from essay 2, that is what we built upon to use for essay 3. And we went back and we looked at the technology-related disclosure indicators in the 10Ks, in that data and that language, to look for AI, Internet of Things, smart technologies, anything of that nature. And once we were satisfied with what we found, then we moved forward with doing the heterogeneity tests and sensitivity tests and checks. So with that, the results overview. So SA2 focuses on 387 firm year observations between 2012 and 2023. And external property management was observed in 280 of those observations, or 72.4%. Internal property management was observed in 107 observations, or 27.6%. And our ultimate result was internal property management is associated with higher accounting-based ROA. And then in SA3, so the test technology related disclosure against G&A intensity and FFO over share, the main result was not finding a clear short run G&A improvement by disclosing such technology. And the FFO share association is negative in the main model, with the interpretation being technology disclosure may affect transition costs, learning, or strategic signaling. For SA2, the descriptive evidence, some of which we talked about being the observations, 280 external property management, internal property management, 107, ROA 1.0% for external property management and 2.3% for internal property management. G&A and assets is 1.8% for external property management and 1.4% for internal property management, with log total assets at 7.54 for external property management and 7.90 for internal property management, with leverage at 47.9% for external and 46% for internal. And the big takeaway with this is that REITs with internal property management are larger and show higher accounting-based ROA, but this also confirms that management structure is not randomly distributed. And then the main quantitative findings. So selection into internal property management. So larger REITs are more likely to internalize property management. And sector effects in that SA2, in that data set, are pronounced. And that internal property management is not randomly assigned, meaning that they do make a specific intent to move forward with internal property management rather than external. Entropy balancing. So external REITs are reweighted to match internal REITs on log assets. And the log assets balance from 7.54 to 7.90 to approximately 7.9 or 7.9. And the ROA result, internal property management coefficient, was about 0.0134 and approximately 1.3 percentage points for the ROA, with, marginal significance at 0.08. And the G&A result, the direction is favorable, with evidence being weaker than the ROA result, and scale appears central to efficiency differences. So for SA3 results, so the technology disclosure findings, the operational efficiency is that technology-related disclosures is not necessarily associated with lower G&A expenses, and there's no clear contemporaneous cost efficiency payoff with that. And the financial performance, the technology-related disclosure is negatively associated with FFO and share, with the main result beta negative 0.63 and the p-value of 0.043, with the mean FFO share is 1.63. And for the interpretation of that, it does not support disclosure equals immediate payoff, and it may reflect upfront costs, implementation friction, learning, or reverse causality, being best interpreted as disclosure signaling and not proof of technology impact. So the simplest way to explain that, from my understanding, is that SA3 does not support simple technology disclosure equals immediate payoff story. SA3 results for heterogeneity and moderation. So the property type moderation. So it's expected stronger positive effects in data-rich sectors. That was not supported for the data, to the best of my understanding. Office and industrial reference sectors showed a negative association, and the reference sector disclosure association was beta of negative 0.98 and a p-value of 0.035, with the other sector interaction being positive with a beta of 1.3 and p-value of 0.021, and specialty sector interaction is positive but marginal with a p-value of 0.06. The internal property management moderation, the disclosure by internal property management interaction, was not statistically significant, and the interaction estimate is supplementary in model with a beta of negative 0.80. Cross-sectional robustness model was 117 observations with an R-squared of 0.208. So for this particular part of the data, the technology disclosure associations vary by property type, but there's no broad short-run gains or clear internal property management complementarity. So going into the integrated results across the assays. So construct clarity matters. And in that, it's the property management being self-advised, external advisement, of which must be separated. And this distinction shows how prior findings are interpreted. Internal property management is conditionally valuable, with larger firms being more likely to internalize, and internal property management is associated with approximately 1.3 pp for the ROA. And G&A evidence is directionally favorable but weaker. Technology disclosures do not show immediate payoff, and there is no clear G&A improvement and negative FFO share association in the main model, with results being more consistent with transition costs or delayed benefits. And ultimately, the main conclusion to that is REIT performance depends on fit among structure, scale, sector, governance, and capability development. And results are adjusted associations and not causal estimates. The contributions from this dissertation include conceptual clarity, separating property management from advisement, and integrating various different theories. Measurement contribution, it builds internal property management and technology-related disclosure measures from the Edgar text. The empirical contribution is that it estimates predictors of internal property management and technology disclosure associations with GNA and FFO. And it has conditional findings to include the test sector differences, governance controls, and disclosure by internal property management complementarity. And it also has practical relevance. It provides evidence to inform property management structure decisions and future disclosure-based technology research. And practical contributions. Property management decision support. It identifies firm characteristics associated with internal property management, including size, sector, fee, burden, and operating structure. Governance and fee burden lens. It helps boards evaluate whether external arrangements create monitoring, incentives, or cost concerns. Technology disclosure interpretation. It provides a framework for reading AI, IoT, and smart building disclosures as strategic signals rather than guaranteed performance improvements. And it can be part of an investor toolkit as it utilizes standardized Edgar-based measures to compare peers on property management structure, technology disclosure, and efficiency. Planning and risk. It encourages boards to evaluate technology initiatives through implementation stage. CapEx needs, operational readiness, and sector-specific use cases. So it shows that internal property management and technology disclosures are strategic choices and not universal best practices. Limitations and risks. Disclosure is not implementation, meaning that a 10K mention does not reveal that they're actually utilizing software or internal management or external management or the depth spending or operational maturity of the organization. It's not one size fits all. Associations may differ by cycle, sector, property type, and operating structure. And associations are not causality. Public data supports adjusted associations, but not definitive causal estimates. So a final takeaway with this is that this dissertation does not argue that internal property management or technology universally improves REIT performance, but it provides an opportunity to shed light on data showing how it's being utilized today. And with that, I thank you guys for your time and I welcome any questions.
All right, Garrett, as chair, you get the first dibs.
Okay, sorry, I had to unmute.
Oh, no, perfect.
Excellent. Okay, so I think you summarized it well just there at the end. But I do have a couple questions, right?
Sure.
So in your essay too, when you were discussing, internal versus external, you did mention in passing that the choice was sector specific. Do you recall from your findings which REIT subsectors were more likely to go internal, or conversely, which were less likely to go internal?
That's a great question, Garrett, and I don't recall off the top of my head, but I can look back at the data and give you an answer on that.
Okay. There, I mean, it may or may not be useful, but if we see a pattern that certain types of sub REITs, were or were not, there might be something that could be interesting to say there.
Sure.
Then I guess my other question, and this is maybe the biggest one. I think most would agree that, and especially for a DBA program, that ultimately the usability or the implementation is maybe the most important thing. And so since we had a sort of unexpected result that technology disclosure had a negative relationship, at least with observed performance. And I know there at the end you did highlight how disclosure doesn't necessarily mean implementation,
Right.
but it is unique because from a finance standpoint, we argue in finance, right, that well, management discloses an investment. We disclose a project. The external capital markets kind of analyze the value of that project, and then either rewards or disciplines the company based off of its expectations of how helpful or useful that project is going to be. And so this sort of implies that REITs saying, "Hey, we're doing these things in technology," is being punished. So do you have, and this isn't something that's going to be necessarily found within your data, but when you were kind of doing your work, did you think about ways that perhaps REITs could communicate the information differently, so that prospective investors found the expenditures more useful? And if the answer is no, you haven't thought about that, it might be something to consider, because that could be valuable, right? That I don't think, in 2026, I don't think, no matter what industry you're in, if you're running away from technology, that's probably a bad thing. So I think I think firms want to invest in technology, but they also don't want to be punished for it, right? So,
That's a great question, Garrett. To date, I have not thought of that, but I think that absolutely could be something for future research.
okay, excellent. Well, those were the two things that I had off the top of my head. I have a few other notes on the side, but I certainly would like to give opportunity to my other committee members. I guess BK, if you're there in the room, I'll let you go next if you have any questions.
Yeah, good job, Jesse. So regarding SF2, like what is exactly your contribution? Because this has already been done, I think, in many papers. So I thought, like, for SA1, analyzing and including those prior work, but you did it as a separate essay in SA2. So what exactly contributed there, if I may ask?
So it's a great question, BK. Ultimately, I would say that SA2 solidifies data that others have collected, and more importantly, the data set from SA2 was what was the basis for SA3.
Okay. Okay. And SA3, I'm also a little bit confused because you are saying the disclosure. So what type of disclosure we are talking about here? If you can explain that.
Yeah, absolutely. So previously, the way that I was looking at it was technology adoption. And because with the data, we can't say with certainty if it's being adopted or not. So it felt more appropriate to say that it is technology disclosure, meaning that we're seeing in the 10K that technology is being disclosed, that they may or may not be looking at it, but not to be saying with absolute certainty that they are using it. And I think that's more the direction that it's going. The comfort level is, unless we had absolute positive data that's saying, yes, this company is in fact using technology in these facets, to say that it's being disclosed.
So I think in that line, you have a way to figure that out, because technology adoption would be a capital expenditure. So if you see that there is a delta, there is a change with the disclosure, let's say firm C REITs saying that we are adopting AI-based renting procedure and in 2022. And so if you see that there is a positive change in capital investment in comparison of 2021, then you can say, yes, it matched and the company has done it. And then you can rerun in your analysis and see that. So what I see the disconnect is the disclosure itself, right, does not do anything.
Sure.
Because where they're implementing it, that matters. And I have to go back and look at your dissertation. I don't know how you define it, disclosure. Is it like they're saying they're going to do it, or they have done it? Like how did you define it?
Sure. And I would have to look back to, further delve into the exact definitions of it. So it is more recently through feedback that I updated to having it as a disclosure versus adoption.
Okay. Yeah, so I would, because contribution-wise, I think yours 3 is what, because the SA1 and SA2 is basically just, as you confirm, that it's just, approving or certifying the prior work. So SA3 is basically your contribution. And there you found a null result, or probably a counter intuitive result, right? In negative. So I'd probably go deep into it, maybe making sure that, because, to make sure that the disclosure itself is not enough, and then you can justify that.
Okay.
Maybe if the result comes that when you use delta, like a change in capital investment in the year of technology adoption by the REIT, they might give you a different result, and then you have a good finding that disclosure, the firms that disclosed do it, and the firm actually did it. There is a evaluation that are captured by the market.
Sure.
You see what I mean?
Sure.
So basically, if you find, let's say there are 300 firms that disclose, but only 100 of them actually adopted it, which is evident by the positive delta in capital investment, that means that those, and if you find a positive result, that means you are saying that what you just said, that disclosure itself doesn't do any good until you actually adopted it, which you can basically find out in
Sure.
that.
Sure.
Okay. Excellent.
I appreciate that.
I'm done with. Thank you.
Perfect. Danielle, I know, thank you so much for, attending the presentation, and you must have some questions as well. So you have the floor. Thank you.
All right. Jesse, great job summarizing everything. I think that, talking about a 3 essay dissertation in less than an hour is no easy task, and you were able to condense it in a way that everybody understood what you did. So I have to applaud you for that. That's a great job.
Thank you.
I've provided my comments several times during your process.
Mm-hmm.
And my primary comment has always been to make sure you make a great and good distinction between what self-advised and externally advised versus self-advised and self-managed and externally managed are, because these are non-overlapping characteristics of a REIT. And when I read, especially your essay 1, when you're introducing your research problem, to me, it continued not to be very clear that you made the correct distinction. And I'm hoping that in this last version of your dissertation, you were able to accomplish this. If you haven't, I think that you should still include it, because later on when I read the empirical work, it made more sense. But when you were laying out the research problem, it was a little bit confusing, and I think you have to begin with that so you can lay your research question a little bit better at the beginning or the front end.
Sure.
I was listening to the other comments, and I have to agree with some of them. And I'm going to give you an idea that maybe right now is a little bit too late to pursue, but I think that you should include it as part of what you suggest for other researchers to look at. So I don't think technology adoption would be can be viewed as equal among all REITs. I'm just going to give you a couple of examples so to see whether you agree with my train of thought or not.
Okay.
So one is, if a REIT portfolio is constituted by mostly triple net lease properties, these triple net lease properties are very hands-off to management, meaning management doesn't really have to think about how to manage these, because in a triple net lease agreement, the tenant is supposed to do all the heavy work, and the owner of the property just sits back and makes sure that there's no breaching contract. But besides that, it's just collecting the check. Right. So why would a REIT that specializes in a triple net lease portfolio would want to acquire and make the expense of adopting technology when it's not really needed, versus, and here's where your expertise may come along. I heard you say that you managed some multifamily properties, right? Yep. So I suppose that since these multifamily leases are shorter in nature, the turnover is much quicker, and you really need, in order to squeeze out any profit, you really need to cut your expenses as much as possible. So I suspect that for this property type specialization, technology adoption would be far more beneficial. So maybe you're getting confounding effects when you're throwing all REITs into one bucket and analyzing them as if they were all equally adopting technology. Sure. I suspect that if you weed out property type specializations where technology adoption would be more beneficial, and run your analysis just for those, and then weed out the ones that you can justify wouldn't have to adopt so much technology, maybe your findings would be stronger.
Sure. So
okay,
basically, thank you, Daniel. Thank you. Yeah. So what I'm understanding is this can be an opportunity for future research to break down by REIT type, to be able to see if in each specific REIT type the technology is being adopted.
Yes, and I would say I would write a couple of paragraphs. One saying, look, these are the property type specializations that we would expect more technologies adopted. For these, not so much. And then you give your reasons, right? Mm-hmm. And then you suggest to the next researcher, if you maybe do this analysis for those that adopt technology or are expected to adopt more technology, then the results probably are stronger. Because now you don't have all these other REITs that would have never adopted the technology, but are still as part of your sample and maybe providing confounding effects when you run the empirical results.
Absolutely.
So that's that. I think it's a bit late for it, but I think that still, if you provide a couple of paragraphs in there, it shows that you thought about it and that you say, okay, I laid the groundwork, and this is for the next guy to go and pursue.
Sure.
A comment that I would also want to give you is toward the front end. You talk about three major theories that lay the foundation to why you're doing this. You talk about transaction cost economics. You talk about the agency theory, and you talk about the resource-based view, right?
Yep.
Okay, so when I read, especially the first essay, again, where you lay down, your thoughts, the way you treat these three theories, they seem like that you treat them as separate competing theories. And I think that you could do a better job in how these three theories intersect that lead you to your research question. Okay. It's just one paragraph where you already laid out the three theories. Now let's just put them together, let's blend them, and let's pull out the hypothesis from that blended paragraph.
Sure.
And I think that'll give you a better fundamental, theoretical, grounded hypothesis to then test in essays 2 and 3. Okay. With such strong LLMs that we have nowadays, you can probably do this in an afternoon by simply going back and forth. A strong prompt will do the trick. And I agree with Garrett. You shouldn't shy away from using this technology. It's out there, it's available, and it is helpful. So I think at this point, you talk about efficiency in your dissertation. Be efficient, man. Graduate and get out and make some money.
Yes,
but you should just strengthen this theoretical background a little bit more.
Okay.
And then I have one last comment.
Yes.
Because I think that what you've done it lays pretty interesting grounds for the next researcher. And this goes with the comment that you just got a few minutes ago. You have to make sure you convince the reader that even though you're looking for technology adoption language in the 10Ks, you are careful about saying, I understand that this doesn't necessarily mean that a technology was actually adopted. Okay? And talk about how this is a proxy, not necessarily an indication that technology has been adopted. And then you can do the empirical test of looking at changes in a GNA, because if they did actually adopt the technology, more than likely it will appear in an increase in GNA. Again, maybe it's too late. You don't have the need to necessarily go out and do the new empirical work. But if you at least clarify that you are aware that this serves as a proxy but not an indication, it is more convincing to the reader.
Absolutely.
All in all, great job. And those are my comments for now.
Thank you so much, Dr. Huerta.
Yeah, thank you, Daniel. And then, so at this point, I would like Jesse to leave, and I'll let the committee deliberate. And then when the committee is done, then you can, they'll call you, and hopefully we have a new doctor in the house.
Very good.
Thank you so much. Now.